Well, hello everyone and welcome. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar being brought to you by New Constructs. We're very pleased to have David Traynor, CEO, with us here this afternoon to talk about the pitfalls of price-to-book ratios, ROE, return on earnings, enterprise value, and EBITDA, the earnings before interest, taxes, depreciation, and amortization. So we've got a lot to cover here today. Please join me in welcoming David Traynor. So David, I'm going to go ahead and pass you today's controls. If you would go ahead and share your desktop, we'll get underway here this afternoon. Thanks for joining us, David.
I'm very glad to be here. Thank you for having me. As always, I'm very proud to be working with Interactive Brokers. We believe that every investor deserves access to the truth behind the numbers, to the truth behind the fundamentals that often are only available to Wall Street insiders, which is, why they get in early on deals like Uber and Lyft and why they sell when those companies go public. We're here and we're very proud to provide the Interactive Brokers community with the fundamental insights, the fundamental due diligence that you need to make more informed decisions. You're not going to get this kind of research from a lot of other firms. You're not going to get it from E-Trade or Fidelity or Schwab. So we're proud that Interactive Brokers is stepping up to provide the investment community with an opportunity to level the playing field with the insiders and the Wall Street insiders. I've been doing this work for a long, long time. I was an executive compensation consultant. I was an auditor. I was a Wall Street analyst. I've been a hedge fund manager. And I decided it was time to create technology to do all the work that was required to really understand the truth behind profitability. And today's presentation is going to focus on the pitfalls of relying on some of the traditional ratios and metrics. Part of doing things the right way means you kind of got to recognize the limitations of doing things the wrong way. And there are a lot of shortcuts and easy ways to kind of go about understanding profitability, valuing stocks. And I like to explain why those shortcuts can be misleading and why they're risky, while also providing you with a suitable replacement. I'm not here just to talk about problems. I'm here to give you solutions. So with that, I'll jump right in. And I also like to say, to reiterate what Cynthia said on the front end, is we love questions. So send them over anytime, and we'll be sure to get into as deep an analysis as you want. One of the really unique things about New Constructs is that everything that we do is completely transparent. Whether you're on the education section of our website or whether you're in one of our models, we like our clients to know how much work we do and exactly where it comes from. And at the end of the day, isn't that what technology is for? To provide transparency, to get rid of middlemen, to shine a light in the dark corners. That's what we're doing. So the agenda for today specifically is to focus on price to book ratios, the obvious flaws. Same with ROE, same with enterprise value to EBITDA. And then we're going to show you how to transcend those ratios. What should you focus on? And a big part of our technology is really about doing all the work to build the kind of models that if you had an infinite amount of time and resources, everyone would build. And we make those relatively inexpensive and accessible to the world. And my goal for doing all that is quite simply to improve the integrity of the capital markets. I think we're privileged to live in a country where we can make a living making the system better. And that's what we're doing at New Constructs, and that's what our technology does. And with that, let's talk about price to book. What are the issues? Well, first of all, that's the ratio. The definition of the price to book ratio is price divided by accounting book value per share, right? So if you've got a $20 stock price and assets minus liabilities are $10 a share, then your price to book ratio is 2, not 10. That's a typo. Sorry about that. 20 divided by 10, right? So that's your price to book ratio. And the sad thing here is that this ratio is the basis for the vast majority of value index funds. And we deal with quant folks all the time. And one of the things they will point out on a regular basis is that they like to use price to book as one of the key, what they call value factors or value screens. right? Yes, Greg, we had the ratio wrong. That's a typo. I apologize. The ratio is not 10, it is 2. The takeaway still at the end of the day, though, is that it's a super commonly used metric, right? And we've seen several papers come out recently about how price to book had been a ratio or a factor or screen that has performed well in the past. By past, we mean you're really more than 15, 20 years ago. It is not done as well. There's a lot of reasons for that. First of all, book value is not really an accurate representation of sort of the ongoing value of the business, right? Book value represents sort of the net carrying value of the assets in the business. So if what managers paid for the assets a long time ago represents the value of the company, well then price to book might be a good ratio, but that's not really what they represent. Not to mention the fact that there's all kinds of value in a business that's not captured on the balance sheet. Technological expertise, customer relationships, brand value, etc. More than that, there are things in the past that sort of really can sort of foobar our balance sheets, whether it's a pooling acquisition or goodwill amortization or write-downs. Companies that write down a lot of assets are effectively erasing equity from the balance sheet and manipulating the balance sheet, and that really hurts in apples-to-apples comparisons as well, where analysts and investors can look at two companies effectively in the same business. If one likes to employ the successful efforts method of accounting, they're going to see a lot more write-downs than a company that employs the full cost method of accounting. And those two methods of accounting are entirely up to management discretion. So book value is really an inconsistent and not really good comparable metric when it comes to understanding the assets or value of a business. Using a price to book ratio is not value investing. It's a shorthand for an actual valuation process. And keep in mind, before technology like what we had, that's all you had. That's the only choice that you had. And that's why a lot of quant funds today still use price to book, because it was a quick and dirty way. And keep in mind, most of these quant funds are using multi-factor models. So they got 15 or 20 factors, and 18 of those factors are effectively used to compensate for the deficiencies in these traditional value factors and value screens and quality screens. So, unless you've got a 20-factor model that you're working on using yourself, reliance on price to book ratio is really, really pretty dangerous. More than that, a lot of these funds out there that are claiming to be value funds don't really do anything that unique. That's part of why ETFs have grown so much, because people realize that you were paying value managers or mutual fund managers, active management, for doing work that was not really any incremental value. Most of these folks were quasi-indexers or closet indexers, and therefore not really doing a lot of incremental work, which is why we see when stocks go sideways when the markets go down, we really see almost cataclysmic type of falls, because there's a compounding effect, because there's so many folks really just kind of following the herd, following the traditional rule books, closet indexing, so that when things go bad, everyone's got to sell at the same time, because everyone was buying basically for the same reasons. Nobody's really doing a lot of incremental work, which is part of why New Constructs is so valuable to both institutions and the retail and the self-directed investors, but especially for the retail and self-directed investors, because you're really just not always given the information in as high a quality form as you often think. So a lot of people aren't really trying to even identify undervalued companies or value stocks. They're just going with the traditional screens because that's what everybody else is doing. The herd mentality dominates. A great example of the pitfall of price to book in action, look no further than Kraft Heinz and Warren Buffett. He admitted afterward it was a big mistake. Price to book or book value was not the right measure for Kraft Heinz. And it looked cheap, as recent as February, right? Over 85% of the total assets were goodwill and other intangibles. That's all goodwill and other intangibles often represents is money spent on acquisitions. That's often meant overpayment. Think about goodwill as just, this is how much I overpaid for an acquisition. So how much should that really reflect the value of a business, right? The more you overpaid, the better your book value, and therefore probably the cheaper you look. That's what I would call cheap for a reason, right? And we've done many studies, not just for academics, institutions, but also even for the SEC, that shows that companies that have tons of goodwill who overpay, especially for acquisitions, are all actually the most prone to do write-downs and often the most prone to underperform. On the other hand, our return on invested capital analysis showed that the assets on the balance sheet were overvalued. When companies can't generate enough cash flow relative to the assets on the balance sheet, they're not doing a good job. It's as simple as that. Ladies and gentlemen, I'm here to tell you, newsflash, if you give somebody $100 and they can only make $1 on that every year for you, that's not a good return. If they can make $20 a year on $100, that's a good return. That's the way we think about businesses and stocks, whether they're public, private, anything. That's the way to think about a business, and book value is not going to get you there, right? And then, what ended up happening is that there's a $15 billion write-down in goodwill. 25% of book value gets erased with a stroke of a pen. Why does that happen? That's because the business was rotting away from the inside for a long time. The balance sheet was overvalued. It was inflated because they overpaid. Surprise, surprise, when you overpay for something, you end up having to write it down. That's exactly what our study showed, is that the more that people overpaid, right, the more likely they were to see write-downs. And here's what price to book ratios get you here with Kraft, is that stock is down 63%, while the S&P is up 35% since we initiated coverage with an unattractive rating in 2016. The chart below comes from our website, where we track the performance of the stock and our rating. And the orange, by the way, color is our unattractive rating. All right, let's talk about ROE. ROE is equal to net income divided by total shareholders' equity. Total shareholders' equity is similar to book value. It has all the problems of book value. It is book value most of the time. And so instead of price to book, you've got net income to book effectively, right? And so all the things we said about the problems with book value apply and affect ROE. But quickly, the calculation, and here we got our math right, thank goodness. GAAP net income is $2 a share, and assets minus liabilities are $10 a share, right? That ratio is the ROE ratio there is 20%, right? Typically a measure of profitability and also a performance metric for executive compensation. So what is the real blind spot here on the margin for ROE, right? What are we showing here that's what's unique about this set of slides, right? I already talked about how the book value of the denominator for ROE was messed up. Well, the real issue for ROE is not just the denominator, but also the numerator, right? Reported earnings are prone to manipulation. Here's a great article, and you can get this from the slides as Cynthia pointed out in the beginning, but this is a great article that we linked to, where CFOs in a survey publicly admit to manipulating their earnings, and that sell-side analysts don't adjust for that. Not just me saying this. This is a survey that CFOs publicly admit to fudging their earnings by up to 10 to 20%, and that the sell-side analysts don't fix that. Right? So the earnings numerator of the ROE ratio is subject to accounting rules that are constantly being reshaped. So it's not just that the companies can manipulate it, but the rules are changing. Structural issues, right? So instead of ROE, investors should look at return on invested capital. That's the metric you should use instead. And of course, we will provide that for you in the research that you get for free on Interactive Brokers. But ROE has a big advantages. It adjusts for all the issues in the numerator and all the issues in the denominator, as well as for leverage, right? So you can have two businesses doing the same thing, valued the same way. One could be highly levered or have a lot of debt, and one doesn't. ROEs are going to look very different for the highly levered company versus the less levered company. On the other hand, ROIC is going to look the same. ROIC, the whole idea for ROIC, ladies and gentlemen, is that it is not subject to manipulation. It is not subject to accounting distortion or financing distortions. It is the one version of the truth, and we work very hard. I've been building technology for over 15 years to primarily get return on invested capital right. And I'll provide some evidence later as to who thinks our return on invested capital is the best in the business. You don't just have to take my word on that. So pitfalls of ROE. Back in October of 2014, we pointed out that ROE was misleading for Sierra Wireless. For the prior 2 years, before we wrote the piece, and by the way, there's a link to this piece in the slides, of course, so you can see that we're not just making this up. You can go back and check it. But ROA improved from negative 11 to positive 15. Over the same time, return on invested capital was consistently negative. You can see the disconnect here between ROE and ROIC in the slide, or this chart at the bottom of the slide. The gain on sale of assets produced the illusion of accounting profits, which is what drove it up. Meanwhile, since we rated the stock unattractive, it's down 58% while the S&P is up 45%, and it's still rated unattractive, right? So there's a perfect example. Sorry about that. Perfect example of why ROE is misleading. Let's talk about enterprise value to EBITDA. Before we get started here, EBITDA is really one of my least favorite numbers in the business, especially because it's too often used for executive compensation. So I'm taking the gloves off on this one, ladies and gentlemen. So enterprise value to EBITDA, that's as the ratio shows up here, the enterprise value divided by earnings before interest, taxes, depreciation, amortization. Enterprise value is equal to, typically, the way most people calculate that is market cap plus total debt minus cash, or what we call net debt. And EBITDA is explained above, right? And how do people use it? It's a measure of valuation compared to cash profits. It's especially popular in the private equity world. And most of that's because they just don't have any better data. It's not that they wouldn't do more analysis. It's just that that's the quick and dirty number they can get. And quick and dirty, works some of the time. But when you have an alternative like what we provide in New Constructs, we're saying, why go quick and dirty when you can just get, the complete and comprehensive. So what's the big blind spot for enterprise value to EBITDA? Well, it ignores a lot of the real costs and liabilities associated with running the business. And this is part of why EBITDA really concerns me. There's still a lot of the flaws with respect to GAAP earnings in terms of different accounting rules that can cause two companies with the same business to report different results because of different accounting rules. But one of the bigger things is like this whole idea that you just remove depreciation and amortization. We don't need any capital to run the business. I remember when I was in Wall Street in the mid-90s, and that was the exact argument for how you should value cable companies. Right, all those wires they put in the ground, that was a one-time CapEx expense, and you shouldn't look at them ever having to replace that. Of course, that was completely true, and those stocks drastically underperformed over the subsequent 20 years, but they were selling people on that. It was a one-time cost. So depreciation and amortization of all the capital required to put those wires in the ground, or all those cables in the ground, was a one-time cost, and you shouldn't think about that when valuing the business. Be careful anytime anyone's telling you that they don't need to spend capital to grow their business, because competition is real and there's almost no business in the world that is free of competition, especially not publicly traded companies. Only regulated monopolies tend to be free of competition. And as long as you have competition, you need to spend money to stay ahead of them or to defend against them. Warren Buffett quote on this topic says it really well. With respect to EBITDA, he says, I'll look at that figure when you tell me you'll make all the future capital expenditures for me, right? I like that quote. He has a great way of putting things in a very simple form. So common measures of enterprise value also have issues because it overlooks off-balance sheet debt or operating leases, deferred tax liabilities, underfunded pensions, and employee stock options. So your numerator is often meaningfully understated, right? So it looks smaller than it does, so that ratio looks lower than it should. All these liabilities need to be taken into account of enterprise value because they're part of what's used to run the business, to keep the business, to fund the business, right? So that numerator's got a lot of issues, the denominator's got a lot of issues, and the ratio itself, of course, then therefore has a lot of issues. And by the way, this is not one of those ratios where the issues offset. No, the issues just make each issue makes the ratio that much worse. Because what you find, just to put a fine point on that, is on the EBITDA, they're finding ways to overstate this number, and on the enterprise value, they're finding ways to understate that number. All of these things we're talking about. So we're making that ratio increasingly unhelpful or misleading. We're not, the world is. We're fixing all those things for you. So here's another source of perspective from a very smart person that I used to work with back in the days when I was on Wall Street, and Michael Mauboussin wrote a huge paper that's available for free, and we provide the source for it here on the bottom of the slide, that does a deep statistical study on basically how return on invested capital drives enterprise value to EBITDA. How it's basically it's the driver, and at the end of the day, a shorthand for valuation is not an actual valuation process. I'm not saying you should never use shortcuts. I'm just saying if you're going to use them, understand the risks you're taking. Companies with different tax rates, ROICs, and growth expectations will have different enterprise value to EBITDA ratios. And this paper goes into additional detail so you can have some statistical backdrop to what it is I'm saying here in these slides. So Hertz looked cheap with a reported enterprise value to EBITDA back when we wrote our report in March of 2018. And the really misleading part of that business is that it was really capital intensive. EBITDA completely overlooks the capital intensity of businesses. And that to me is just silly. Like Warren Buffett said, I'll take a look at that number if you're going to pay the capital expenditures for me. It's just silly to overlook the balance sheet of a business, especially for capital intensive industries. So even while enterprise value to EBITDA was looking good, we saw a steady decline in return on invested capital in the years prior to our warning on that stock. And so in the period since, it is down 14%, while the S&P is up 4%, and we still rate it unattractive. So I'm hoping what you find here is not just reasons why these ratios don't work, but real world examples as to how they could have hurt your portfolio if you had trusted them. So how do you protect yourself? What ratios do you look at? We're here to tell you that we think you should look at economic earnings, primarily driven by return on invested capital, and not GAAP net income. Not anything based on GAAP net income. And when I say GAAP net income, I mean that includes everything on the income statement above GAAP net income. So whether you want to look at pre-tax income, EBITDA, or revenue, these are not metrics that are reliable because they do not capture the profitability of the business. Anytime you see a company add non-GAAP in front of any number, that's making it worse, not better. I have yet to see a non-GAAP ratio, even non-GAAP ROIC. I've yet to see a company calculate those in a way that on which investors should really 100% rely. And here's the fundamental reason why that is. Companies should not be in the business of measuring their own performance any more than probably Bernie Madoff should have been in the business of measuring his own performance. There are firms like ours, just like there are firms in the hedge fund business that specialize in performance measurement. And sophisticated investors require any fund in which they put money to use these, what they are called administrators, to measure fund performance. Why? Because they're a third party. Why else? Because I want my managers focused on managing the business, not figuring out ways to measure their performance. That should be done by a third party that does it consistently across all hedge funds or across all companies. So I know I've got an apples to apples number. Again, it's not something that executives should be engaged in. So here's some recommendations about how we think you can make money today by focusing on economic earnings as opposed to accounting earnings. Westlake Chemical. In 2018, GAAP net income fell by 24% year over year, while economic earnings increased 49%. Income statement telling you one thing, due diligence telling you something else. The disconnect comes from $44 million in write-downs and $33 million in one-time acquisition costs. ROE fell from 27 to 18%. ROIC increased from 9 to 11%. What we're going to be doing is going through the fine print, the MD&A and the footnotes, and pulling out these unusual items so we can say, oh, guess what? This business is making some smart decisions. They're saying these assets are not worth anything. We're writing them down because management's smarter about the business than maybe the management before or than they were in the past. In addition to having strong underlying economic earnings, the stock is underpriced at 76 bucks a share. It has a price to economic book value of 1. Price to economic book value is very different than price to accounting book value. Economic book value is a measure based on cash flows, and there's a link to exactly how we calculate that on this slide. But the price to economic book value ratio of 1 means the market expects 0 profit growth. That's what makes a stock attractive in our system. The market is saying the current cash flows of the business will never grow beyond where they are today. So we think those are low expectations. That's a cheap valuation. We like understanding exactly what the cash flow implications behind Mr. Market stock prices are. That's what our valuation process focuses on. And then we're going to look at quality of earnings. So we've got good quality of earnings here. When you combine high quality earnings, low risk stock price, that's attractive risk reward for our clients. And that's what we provide you over the Interactive Brokers platform on 10,000 stocks, ETFs, and mutual funds is an honest and comprehensive assessment of risk reward for every stock, ETF, and mutual fund we cover. And that risk reward is based on an assessment of quality of earnings and valuation. On the other hand, we also see a lot of situations where reported earnings overstate real earnings. So from 2016 to 2018, for Mondelez, GAAP net income grew by 43% compounded annually, while economic earnings declined from $508 million to $413 million. On the chart below, you see the two measures of profitability moving in opposite directions. Always a red flag. ROE, in the meantime, increased from 17 to 13%. The price to book value is 2.8 compared to the average of the S&P at 3.4. So all the value funds are buying this stock. It's very heavily owned because it's meeting the screen for value and meeting the screen for quality. The enterprise value of EBITDA is 19, implies a high growth, highly profitable company. In reality, it's low growth and unprofitable. We see at least 30% potential downside from current $50 share price if Mondelez simply just maintains its margins and grows in line with the industry. The stock is priced to the current expectations for future cash flows as baked into the $50 stock price are for much higher growth and profitability than what the company has experienced in the past. These guys have done a lot of acquisitions that make EBITDA look good, but the business has not really been run that well. And, we think the industry, the sector they're in is pretty hurting, right? People are buying stuff at the edge of the store, not in the middle of the grocery store, and Mondelez focuses on the middle of the grocery store, the middle aisles. So let's take a quick step back. Why do we need diligence to begin with? What's the deal? Why doesn't accounting results give us what we need? I'll tell you that accounting results were not designed for equity investors. They were originally designed for debt investors after the crash of like 1927, right? And so we need to do additional work to understand profitability. Think of accounting data as the starting point. Think of it as the vocabulary, and finance is the language. Finance is what we need to speak economic results. We care about the underlying economics of the business. We need accounting data to get us there, So the work we do requires accounting expertise, but also finance expertise so that we can put that accounting data together in a way that best reflects the underlying economics of the business. All right, I'm good. I'm glad to see some questions coming in here. I'd love to see a lot more because this is sort of where we get into the nitty gritty. The economic P&L, two big differences between the traditional accounting P&L. As you can see there in red, hidden income and charges. So a bunch of hidden gains and losses buried in footnotes. And then secondly, on the balance sheet, there's got to be a capital charge or a charge for the capital that the business employs. We get that explicitly with interest expense. We do not get it for equity, but there's a cost. Investors expect a return on the assets you give them. Otherwise, they wouldn't give them to management. You wouldn't buy the stock if you didn't believe the company was going to make money for you. There are people, of course, who do nothing but technical and sort of momentum type trading. They don't care about fundamentals. We care about fundamentals. And we're here and through the Interactive Brokers platform to give you free insurance for the fundamentals. You get the best fundamental analysis in the business for free through Interactive Brokers. Might as well take advantage of it. Here are all of the adjustments we're making. We don't make these for every single company. We don't have to, thank goodness. But we do make a lot of them for most companies. The key takeaway here is that you should know that we are turning over all of these stones for you in our work. We're making sure that you, when you use our research, are eyes wide open to all of these potential issues that can affect profitability and valuation. We're doing that work. And I'm here to tell you, I don't believe anyone else in the business does this as well as we do. Not even close. So it's a very unique value proposition that we're bringing to the table. All right, some background on some calculations. So I was saying before, we got to go from accounting to economic, right? And there's a few steps for that. The first part of going from accounting to economic is to adjust the income statement. All right, and in net operating profit or NOPAT, that's our adjusted. Think about that as our adjusted income statement, right? That's the numerator in the return on invested capital. Invested capital is the adjusted balance sheet. That captures all capital invested in the business over its life, right? Adjusted for operations, all right? But think about the NOPAT as the adjusted income statement and invested capital as the adjusted balance sheet. WACC, the weighted average cost of capital. Think about that as the rent management must pay for the use of capital. Capital is not free, right? Does anybody know any free sources of capital out there? Not, not counting Bank of America, Goldman Sachs, what they can get from the Fed sometimes, right? For self-directed investors, anybody know of any free sources of capital? Please type in and let me know if I'm off here, right? I know your capital is not free. You're not giving it away to people for free, right? There's an implicit cost for that. It's called the weighted average cost of capital. We calculate that in an extremely rigorous yet consistent way across all 3,000 stocks we cover. So return on invested capital is NOPAT divided by average invested capital. Economic earnings is equal to ROIC minus WACC in parentheses times invested capital. You can also calculate that as NOPAT minus WACC times invested capital. Those two approaches are mathematically equivalent. Economic earnings is also known as EVA, economic profit, residual income, CFROI. These are all ways of getting effectively to the same thing. And we're not here to pretend that our model, our calculation, our mathematics are somehow magically better than everyone else's. I don't think that's the case. I think our model is as good as anybody's. What makes us different is the data that goes into it. It's these adjustments. It's making sure that we bring to you the comprehensive accounting picture. We're looking at all of the accounting data to calculate these really very straightforward ratios better. That's the key. Better inputs, better diligence, so you can make more informed and safer decisions, right? So here's the best part. Here's how you get better research for free, right? What do you want to focus on? As I said before, accounting earnings versus economic earnings. This is a chart directly from the reports that we make available for free on Interactive Brokers. We've got a special section of the front page of every chart, every report, that focuses on how economic earnings compare to accounting earnings. We'll talk about how many adjustments, sorry about that, I got a new mouse, a little super sensitive, how many adjustments we make to the income statement, how many adjustments we make on the valuation side, and we'll also give you, links to all the things you need to understand what's going on. We'll also tell you our ratings. Right? Every one of the reports you get from Interactive Brokers is going to break down quality of earnings and valuation into these 5 criteria. Right? And we're going to show how we think the economic earnings compare to the reporting accounting results. We're not just going to give you this chart with how these trends look. Right? We're going to show you what we think that means with respect to quality of earnings. You can see in the situation for this company, right? You've got economic earnings holding steady and going up even while accounting earnings are going down. That's a good one, right? Return on invested capital, 12%. That's at second quintile. That's a good number. On the valuation side, we've got a 17% free cash flow yield. That's over 10%. That's our best rating. Price to economic book value of 0.9. So the market cap of the company is 10% below the no growth value of the business. That means Mr. Market is predicting that the profits of this company will permanently decline by 10% and never grow above that level. All right. And then growth appreciation period. This is our reverse discounted cash flow model. How long do we have to forecast profits into the future before the discounted cash flow model generates a value equal to the current stock price? And not surprisingly for this stock, Autoliv, whenever the stock price is implying permanent profit decline, you don't need to project cash flows out into the future at all in order for the DCF to generate a value equal to the current stock price. The DCF automatically, if you got any profit growth at all, is going to start out with prices that are above the current stock price. So how can very profitable companies have declining book values? Because they're not reinvesting back in the business, because they're writing assets down, but they don't always have declining book values. Book value can change for a variety of reasons unrelated to the underlying economics of the business. That was a great question that came in early on. I'll get to the other questions as we come through here, but feel free to bring them in here because we don't have that much time left. So what you're going to see when you download a report from Interactive Brokers is this is the front page of the report. And you're going to get, as I showed so far, the rating system, details on how accounting earnings compare to economic earnings. You will also get backup details on the trend for return on invested capital, free cash flow yield, price to economic book value, and growth appreciation period. We'll have charts and tables for all 5 of these criteria that go into determining the overall risk-reward rating. And how do you access? I'll probably pass over to Cynthia here in a minute to go into more detail about how to access, but you can get to new constructs through both Mosaic and the Classic Analyst interfaces. Go in and find new constructs and just click on one of our forensic stock earnings and valuation reports. You can see that we're sending in tons of reports every day, and they're readily available. If they're not, let me know. Let me know if Interactive Brokers doesn't make them available, because I know we're sending them to them every day. 10,000 reports on stocks, ETFs, and mutual funds. And lastly, I want to kind of finish up here just talking about who else thinks our data is good. Why are you going to believe David Traynor? Well, partly, of course, because Interactive Brokers believes us, which is great. But how about a third party like a Big Four accounting firm? They got a pretty good reputation, Ernst & Young. They've got a white paper we wrote a couple years ago that proves our data is materially superior to Bloomberg and Capital IQ. Check the appendix in this report. Download it for free from these slides or from our website. And it pretty much says it all, and it really focuses on how important return on invested capital is This isn't just a message that we wrote for no reason. This is part of what Ernst & Young brings to the C-suite of corporate America to help those managers better serve their owners or shareholders, to prove to institutional investors that they are good stewards of capital, that they care about earning a return on investor capital. And they talk about this report to, or they use this report to show why their approach to calculating ROIC is better, cleaner. Peer 1 in the appendices is Dow Chemical back in 2015. Data provider 1 is Bloomberg, and data provider 2 is Capital IQ. And then you'll see that our data is stacked up right next to theirs to show where our data captures gains, losses, and other balance sheet assets and liabilities that the other folks miss. And we're not talking about a small cap company here, right, that nobody has time to look at. We're talking about Dow Chemical in 2015. They've had a lot of time to go get that data, and it's a mega cap company. My point is, no one has the technology to do what we're doing to get the data as well as we do. In fact, our technology is so unique that Harvard Business School wrote a case study titled "Disrupting Fundamental Analysis with Robo-Analysts," and that's what we call our technology. It's the machine learning that we brought to the process of fastidiously and painstakingly going through filings. We've got humans who've been doing that work for over 15 years. We've got 200,000 filings that have been highly, carefully annotated by human experts so that machines can use those human expert reviewed filings to more intelligently figure out how to go through the filings on their own, right? The idea being, if we've shown the machine in a filing that cost of goods sold should go into the operating expense bucket for 1,000 companies, we don't really need a human to do that anymore. We've taken that mentality slowly, carefully, deliberately to all the really easy things to get from financial statements, footnotes, so that the machine can do this work and free our humans up to look for the more difficult things to find in the MD&A, in the footnotes. The idea being that we've leveraged technology to make human beings smarter, more productive, and to make our clients smarter investors as well. Harvard Business School and MIT are teaming up together on a paper that will prove the material superiority of our data versus what you can get from CompuStat and street earnings. In particular, I'd love to talk a little bit about some of the conclusions in this initial draft. This paper serves as a warning for researchers seeking to examine the value relevance of earnings. So they're telling you, if you really want to understand profitability, we warn you against using the traditional metrics. Data aggregators like CompuStat do not appear to collect and provide data on many of the non-operating or less persistent income-related items. You can't even find the adjustments that we make in the financials or in the numbers that CompuStat provides. About 35% of the time, that applies to things from the income statement, and then from the footnotes, I don't know what the percentage is, but they have almost none of them. But even adjustments we're making from the income statement, 30 to 40% of the time, you can't even find that in CompuStat. It's not me saying it. It's Harvard Business School and MIT. Right? Those guys are a lot smarter than I am, and they're saying it. And so you see here that basically, the takeaway is, if you really want to make investment decisions, eyes wide open, if you want to make investment decisions based on a full understanding of the fundamentals, New Constructs is one of the key places you got to go. And if Interactive Brokers is giving it to you for free, why not take advantage of that free insurance? I'm not saying you have to get rid of all your other strategies. I'm not saying the fundamentals should be 100% of the process, but I am saying it shouldn't be zero. Not when it's made available for free for you. No cost, a lot of diligence. That's a win-win. I'm going to take a couple questions here real fast before I go to the next section. Growth appreciation period. What is that most sensitive to? There's no real answer to that, right? Growth appreciation period, is a function of how fast the business will grow and how profitable it will be. Profitability is broken down into operational processes and capital allocation processes, and all of these things can affect really how the company generates cash flows in the future, as can growth, right? And so growth appreciation period is probably it's a function of all those things. But if there's one number I'm going to point out as being the most important, it's return on invested capital, right? The academic definition of growth appreciation period is the number of years a company can maintain its competitive advantage. That's expressed mathematically by the number of years a company can earn a return on capital above the cost of capital on its new investments. In other words, it's the number of years a company can grow its economic earnings. So if you got two businesses, one with 100% return on invested capital and one with a 15% return on invested capital, both have a WACC of, let's say, 12%. I'd say the growth appreciation period for the one with a 100% return on capital is likely to be longer, just because their return on capital is higher. They've got a sort of stronger competitive advantages, so they should be able to grow profits for a longer period of time, just because they've just got a higher return on capital. That doesn't mean anything. The other thing I would point out is it doesn't really matter what the growth appreciation period is. It matters what the market's implied growth appreciation period is, right? No matter, a good company is not a good stock, right? So we always care about what the valuation implies. And we buy stocks where the market's expectations or the market's implied growth appreciation period is lower than what we believe it will be. We want to sell the stocks where those expectations or the growth appreciation period are higher than what we believe them to be, right? So it's always about competition and what the market's expectations are. Here's another great question. How do we make money if our stuff is free? You use it. You use it better than other people. Look, as I said before, we're not on other platforms. We're not on every platform. And you're right. The person who wrote in this question, you're right. At some point in the future, probably everyone will use this technology. It's the sort of, it's the fundamental right of all investors to have access to the truth behind the numbers. And at some point in time, everyone is going to be probably making investment decisions with an eyes wide open understanding of fundamentals like what we provide. I have many institutional investors tell me they think the government might take me over, right? The SEC needs us. It's true. But you make money by running your portfolio through the new constructs lens. Make money by not putting a lot of capital into stocks that get unattractive ratings and focusing more on attractive ratings. I'm not here to say we've got a perfect stock picking tool, that I've got a crystal ball. If I did, we'd be doing this meeting on my yacht, right? But what I am here to help you do is make better fundamental decisions. We're here to help you have access to better information. And I can't guarantee you're going to make money. I can only help you make smarter investment decisions if you use new constructs. And there's three ways you get a big advantage. Number one, you use our system better than others. Number two, you use it before others, right? And number three, you use it when others don't, because not everybody's focused on it, right? So that's how you make money using our stuff. So I'm going to go a couple more minutes on talking about why it's more important to use our work than ever, and why you need protection. And the first reason is that filings are getting longer and more complex than ever. I spent 5 years serving the Financial Accounting Standards Board on the Investor Advisory Committee, and I can tell you disclosures are getting more complex than ever. Sometimes disclosures move the world in the wrong direction. This new rule about running unrealized gains and losses through the income statement and balance sheet, terrible. Step back. Bad for investors. Why did FASB do it? I can tell you, having worked with FASB for several years, a lot of different influences and heads in the room, and they don't always make the best decisions for investors. Part of that's because the history of FASB was not always to serve investors as it is today. FASB used to be funded by corporations entirely. There's a little conflict there, right? The SEC and other firms just lack the tools, they lack the skill, they lack the expertise to do the work we're doing. Accounting rules are constantly changing, they're getting more complex. All I can say is that you're better off using our tools than at least a little bit than of course not at all. It doesn't help that you got these guys out there telling you to buy stocks like Lyft and Uber, right? I don't know if you guys saw, but after Kramer did one of his bullish rants on Lyft, he got trashed so hard on Twitter that he said he was going to quit Twitter. Of course, he didn't, but anyway. On Bubble Vision or any of these other sort of entertainment/investment sites, you're getting a lot of bad information. We're helpful. We're hoping to provide some antidote to that propaganda. And I think at the end of the day, too, I think most people are beginning to realize that technology can do some things better than humans. And I'm here to tell you that a machine can read an income statement better and faster than a human. Machines don't get tired. They don't lose focus. And I'm telling you, when you're dealing with a 200-plus page 10Q or 10K, I've done this a lot. This is a picture of me when I was on Wall Street. As hard as I tried to concentrate, as hard as I worked, it was very difficult to maintain focus for 250-plus pages. Cynthia, I'm going to stop there and we'll take some more questions, but I want to make sure we'll leave you some time to walk people through exactly how to access our information on your system.
Okay, well, thank you, David. I'm going to grab the controls back for just a moment, and what I would like to do is walk everyone through how you can access that information on the Interactive Broker platform. Let's go ahead. I'm going to share my screen, and as soon as it comes up, those of you who are Interactive Broker clients will recognize I'm in Trader Workstation, where you can access the new constructs research. How do you do that? Well, notice underneath the new window button, there's actually an analyst research selection that's included here. From this information, notice that under the subscribed, you'll find new constructs research. Now, it's there whether you've subscribed or not, because as David mentioned, this is free to all Interactive Broker clients. So you can come into this information and then simply click through. By the way, before I go into that, once you have entered the information, you'll see that our new window menu now brings up the information you just recently accessed and keeps it right up there at the top of the screen. So let's go back into the new constructs, and you'll see this actually opens up a separate window here. As David mentioned, we do receive files daily from new constructs, and you can find the information from here. Now, if there is a particular ticker symbol that you're looking for example, I'm just going to pull one up, and you'll see that simply adding that ticker into the search field is where you can find some additional information. Click on that and notice here you'll actually get that report and can launch it directly from the Trader Workstation. Let's see here. Oh, I do have it. It's showing up down below. I'm going to bring up, let me come in here. And notice I have several of those reports. Once you click on any of the reports, you'll be able to see those same reports that David has been showing you today. Notice here there are several different pages that are available in the report with the different charts that David has been talking about. So you get quite a bit of information that's available on any of the firms that you are searching for. So I did want to mention that. Also, do want to let you know that we also do include some more advanced material. So what I'm going to do is let's get back to my website here. And underneath the pricing menu is where you can find, you'll see here, there's research news that's available. Now, to save some time, I've already pulled this up. And by the way, you can simply do a find for new constructs. And here is where you can find the information that is available. Notice, as David was talking about, that our reports on stocks, ETFs, and mutual funds are available at no additional charge. Now, there's also a more advanced research and alerts that are available for institutional clients. But while I'm here, you'll see that that monthly price is available. But if you'd like to take a look, we even do provide you with a one-time 30-day free trial period if you do want to take a look at the information provided. Now, also notice that from that pricing menu, you can actually go in and learn more about new constructs, view sample reports, and even visit their website. So I did want to mention that all of this is available, and not only in our Trader Workstation, but also if you're using our mobile application, you'll find it available on a on a smart tablet. So did want to mention that. Now, with that, if you do have any additional questions, want to remind you that you can actually there is that chat panel over on the right-hand side of your screen. Now's the time to enter the information if you do have it, or enter any of your questions that you might have for David. So, David, are you seeing any additional questions come into our panel here today?
Yeah, I got one more question, a couple more. And if you want to go ahead and, if you don't mind passing access back to me, I'll show people our website for a second.
Absolutely. I'm taking you back to the website.
Great.
You'll need to, there you go.
So yeah, one of the questions was, how does New Constructs make money, right? And if we're giving stuff away for free, and the answer to that is that we offer additional information if you want more data and more features, not just for what you see also through Interactive Brokers. They give you a really special deal, and getting one of our professional cert licenses. You get the unlimited version of our research for like 50% off, which also gives you access to a ton of great screeners, tracking of your portfolio. So we'll send you alerts anytime there's ever a change in any of the companies that we cover or that you have in your portfolio. So there's a lot of additional services that we can provide. I also want to make sure everyone knows about the education section of our website. We're doing a ton of work here to help people understand all the great things we can do for you. And so, like, for example, here's a excuse me, here are white papers and all the adjustments we make. Excuse me, got something in the back of my throat there. Anyway, so it's totally transparent. We're here to help clients make more informed decisions, and we want you to understand how much work we're doing. One last question on, do you have to open an account to get access to New Constructs? And Cynthia, I believe the answer to that question is yes. You need to have an Interactive Brokers account to get access to the free benefits.
Yes, you do. We do have some limited information available in the demo account, but you're not seeing live data there. But do try, and as I showed you, if you are using the data or the demo account, do try under that new window button to see what is available for you. But as David mentioned, it is available to all Interactive Broker clients directly from the Trader Workstation.
That's it. I think we're out of time.
Okay, and right on the nose. Excellent, David. Well, thank you so much for today's information. Also, would like to remind everyone that we have been recording today's event, and David did cover a lot of different concepts here. If you want to come back and review those concepts, simply watch your email later on this afternoon for a direct link to today's recording, as well as access to the same slides that David's been using for today's session. By the way, check your Trader Workstation as well, and look up some of those reports for for items that you may be considering. So with that, special thanks to David Traynor, CEO of New Constructs, for today's presentation. We'll also have this listed on the Interactive Brokers website. Underneath the education menu, you'll find a webinars link where you can access not only today's presentation, but David's been building a library of information that's available there as well. Simply go to the Find feature. You can access the information and look up by either by sponsor or by presenter. So special thanks to New Constructs today and to David Trainer for some terrific information. So thanks everyone for your participation with us this afternoon. You can all exit today's information by simply using the X in the upper right-hand corner of your screen. Thanks everyone for your participation and have a great rest of your day.
Thank you.